Good morning. I'm Gord Long with the Financial Repression Authority. I have Jordan Eliseo joining us today from Sydney, Australia. Jordan is the chief economist at ABC Bullion in Australia. Has been a guest with us before. Welcome back, Jordan.
Gordon, it's a pleasure. Thanks for having me back. Very excited to come back on the show.
How quickly the time goes, doesn't it? Just flies by.
It does. It's been an amazing couple of years in financial markets, gold market, equities, you name it. So I'm sure we've got plenty to talk about and catch up on.
We always do. Jordan, we have so many new listeners that may not be familiar with your background and ABC Bullion possibly. Even though you're one of the biggest players in the world, I need to make that statement right off the bat.
Yeah, sure. So if I start off just explaining who ABC Bullion are, we are the largest private bullion dealer in Australia. We've been operating since 1972, and we are the bullion division of Pallion. Pallion, our parent company, is actually the largest precious metal services group across Australasia. So we have 8 businesses within the group. That includes ABC Refinery, which is the London Bullion Market accredited gold refiner that obviously produces all of our products. Then there's ABC Bullion, which is the arm of the business that I obviously work for, where our clients buy, sell and trade bullion through. There is also Custodian Vaults, which is a non-bank, high security private vaulting facility for private and institutional clients. It's located in Sydney, so we have clients all over the world using that vault. And then there are also a handful of businesses that are involved in jewellery manufacturing, production and design as well. So it's a fantastic business. The motto of it is from mine to market. We basically have a hand in every step of the precious metal value chain, as it were. And for me personally, I'm coming up to it's now my 20th year in financial markets, Gord. So I came straight out of high school, and whilst I was studying, started working for asset managers. I've been a precious metal bull since 2003. I've had the majority of my wealth in precious metals since then, and have been very honoured to join ABC Bullion a few years ago now to help expand the gold story in Australia and explain the merits and the importance of owning physical metal for everyday investors.
Jordan, I have up an agenda of some of the subjects I'm hoping to touch on. We never actually get through it all, so I'm going to jump right in. What's happening in precious metals from your perspective in Australia, Southeast Asia, and just the world in general? Because I think there's definitely a change in tone that's happened here in the last 3 months.
I think that's absolutely right, Gordon. I mean, obviously Q1 has just come to a close, and it's been a very impressive quarter for anyone who's been long precious metals. We had gold up something like 16%, silver up around 11% for the quarter, which are obviously, those are the kinds of returns you'd be happy with them over an entire year, let alone 3 months. Now, look, that is, impressive as that has been. It is in many ways sort of welcome respite after this sort of cyclical correction that started taking place in precious metals back in 2013. The interesting story, though, Gordon, I think, is that what we're seeing is this recognition now when it comes to gold investing that, look, in a world where equity markets are increasingly volatile and the bull market in equities is looking like it might be over, and where central banks are clearly having to take ever more extreme monetary policy positions and decisions, the merits of holding gold makes sense as part of a portfolio again. And probably the most interesting place we're seeing that in the last 3 months is actually, funnily enough, through gold ETFs. So, in 2013, 14 and 15, particularly 2013, there were just hundreds of tons of gold divested from the major gold ETFs. In the last couple of months, the last 3 months, that trend has noticeably changed. I think GLD alone added something like 180 tons of gold in the first three months of this year, which is more gold than what Russia and China are buying, if we just look at buying at the state level. So there's been a real trend change, and the conversation around precious metals has very much altered from what it was in 13 and 14 and 15, when people were very bearish and just didn't see the need to hold it in the portfolio, to a conversation now where people are, if not adopting it as a major holding, openly looking at it and analysing the merits of including it as an asset in their fund alongside equities, fixed income, and other more traditional assets.
Yeah, the institutions have really never paid any attention to gold in any fashion, and the simple fact that they're even nibbling at it now, and I think negative interest rates have prompted some of that beginnings of an interest. But I have some people that have been long term in gold, and they're arguing if there's any significant interest in GLD or any of the ETFs, there will be a shortage of them being able to back it with physical gold, just being able to get their hands on it, any kinds of transaction. Is there any validity in that observation?
Look, I sympathise with where the argument is coming from, but it's important to remember, I mean, there are several thousand tonnes of physical gold sitting in either the BOE or other bank vaults in London right now. There is actually no shortage of gold in London at this point. And there's also, the better part of 3,000 tonnes of, organic or freshly mined production, being brought to the market every year. So, look, I am not one that really delves too deeply or worries too much about that sort of element of the gold market or, COMEX defaults or anything like that. The broader story, and actually I've got a piece that it will be publishing for our clients today. The broader story is actually the renewal of Western investor appetite, even if it is coming through ETFs, is actually a good thing for the entire precious metal industry. I can tell you that, if I look at the chart of ETF inflows, it's clearly picked up in the last 3 months. That has been correlated to the rise in the gold price, and as a gentleman working for ABC Bullion who obviously deal in direct physical metal, I can also tell you that we've seen a noticeable pickup in inflows, particularly from self-directed retirees and our institutional clients down here as well. So, look, I am, when it comes to trade flexibility, when it comes to cost, and when it comes to security, there is no question that direct physical metal and segregated holdings are the superior form of bullion ownership. But I am all for people buying gold through the ETFs as well. It's good for the entire precious metal complex. So I think that's important to note. And it also bears saying, Gord, that whilst there is this, to me, there is a real bid under the gold market that is there as a result of this pro-cyclical buying out of emerging markets, China, India, the Middle East, and also the activity by central banks who are now buying 500 to 600 tonnes of gold a year rather than selling 400 to 500 tonnes a year like they were pre-GFC. So central bank demand and emerging market demand are, to me, the bid under the gold market that will support it for the next few years. But for gold to really move substantially higher and have a kind of move like it did in the 70s, for example, we will actually need to see Western investors adopt it in their portfolios. It doesn't have to be a major move. If gold became 2, 3, 4, 5% of the average Western investor portfolio, we'd see prices move much higher. And I think that's probably what some institutions are starting to look at now, saying, well, look, in a world where we're going to earn less than nothing on cash, where there's $20 trillion of sovereign debt trading at negative real yields, then it probably makes sense to hold this asset class. It's highly liquid, it's easy to trade, it's actually not that expensive to store, particularly when you're doing it in volume. So I think the gold story has got a really bright future, pardon the pun, for the next few years.
Yeah, Jordan, my observation is since Japan announced NERP, even though we'd had it in the EU negative interest rate policy, and in a number of countries in Europe, but since we had it, a lot more discussion on a cashless society and restrictions on that, along with bank bail-in legislation. To me, that's what's beginning to trigger some serious consideration as gold. Are you observing that? Because it correlates with when Kuroda actually made his announcement.
Look, I do think the sort of announcement by the BOJ and the move to NERP, as well as their latest announcements about giving away gift certificates to people, I think they have very much changed the game, and the perception around financial market risk, and really just where this monetary experiment is headed, be it in Japan, Europe, China, the United States, even here in Australia, I have no doubt rates will go lower as well. So I definitely agree with you, Gord, that that decision has really changed the perception around financial markets as a whole, and therefore gold's role in it. I think it depends on what kind of investor you're talking to, though. So if you're talking to a retail investor who is incredibly concerned about QE and bank bail-ins, then obviously there's an argument for holding gold that's only been strengthened as a result of what the BOJ decided to do. If you're talking to an institutional investor who's got a volatility mandate and a return objective that they're trying to hit for their clients every 3 months to 12 months or whatever the mandate is, then for that type of investor, their interest in gold, or their growing interest in gold, is much more around the potential for it to deliver alpha in a low rate environment, the fact that it's uncorrelated to financial markets. And I think this other one, Gord, which is a real sort of issue, sort of slightly under the radar right now, and that's liquidity. And if you look at liquidity, it is drying up in financial markets. I think it was...
It's not getting the press it should. It really is.
Which is an extraordinary scenario when we consider the attempts of central banks to flood the markets with liquidity. But you even have in the last 6 months, I can think of, well, I should say the last 12 months, we've had the Bank of England, we've had the Reserve Bank of Australia, we've had institutions like JP Morgan all come out and warn about waning liquidity in markets. And I think it was actually the head of Aberdeen Asset Management, don't hold me to that, but I'm pretty sure it was, who actually came out in the press and spoke about the BOE or regulators in the UK perhaps changing the rules around daily redemptions for bond funds, because they are worried that actually the liquidity might not be there in the event that that investors seek to move to cash and liquidate their bond portfolios. Now, that's extraordinary because one of the selling points of bonds is that they're supposedly low risk and highly liquid. There's a big question mark about whether that will really prove to be the case in the next few years. So I think with that in mind, if you're an institutional investor, well, you've got large pools of FUM you've got to invest. So you actually need a large market to go into. Gold fits that bill. The nominal value of all the gold in the world is well over $6 trillion. It's larger than every sovereign bond market, bar the Japanese and US Treasury markets. And of course, it has the advantage that there is exactly zero credit risk in it, despite its growing size, which is very different, obviously, to those bond markets. The fact that it's highly liquid as well is a real positive for an institutional asset manager who has to keep that in mind when allocating capital. So, I think the reasons for buying gold might be different depending whether you're talking to a retail or an insto client or investor. But either way, there is clearly growing interest from both sides of the market.
Yeah, I agree with your point about liquidity. I do a lot of collaboration with Richard Duncan, who actually has a liquidity gauge, who has been measuring it for years, and he was formerly with the World Bank and IMF, so he really understands it. But when you look at capital flows, which Martin Armstrong tracks vehemently close because he's a currency specialist, what Richard's tracking with in terms of liquidity, and then if you look at the credit cycle, which we happen to believe the credit cycle has turned, there is a significant overall liquidity issue that's starting to really shake itself into the market. But it's going to show itself in Q2. It's already showing itself. But I need to switch gears here, Jordan, if I could. Silver.
Sure.
We haven't talked about silver, and I notice in the gold-silver ratio that from a perspective that silver is at levels that says it's underpriced relative to gold on many historical measures. Any observations on what's going on in silver?
Yeah, look, absolutely, Gord. I think if you look at, let's call it 80 to 1, where the ratio is now, or roughly around 80 to 1, really in the last 20 plus years, there's only been one period where silver has been even cheaper relative to gold. I think it sort of got up to about 100 to 1 at one point. So we're at a level now which, the last 3 times we've reached this kind of ratio, it really did mark a bottom in the gold to silver ratio, and silver comfortably outperformed to the upside. For me, from a personal point of view, You know, the majority of the wealth that I want in precious metals is already there. But you know, from a personal point of view, I can openly say that pretty much every week or fortnight, I've just been adding a kilo of silver to my savings, and you know, because it is just so cheap now. I think there's a couple of reasons why it's so cheap. First and foremost, if we look at what happened in 2015, there was an absolute bloodbath in industrial and energy commodities. And whilst gold has long been recognised as a pure monetary asset and risk-off store of wealth, silver to this day, still very much wears that quasi-industrial, monetary status. So when you have environments where there are concerns around declining rates of economic growth, and where the broader commodity complex is selling off, it's quite natural for silver to sort of, the baby gets thrown out with the bathwater, as it was, and we see silver underperform to the downside. But as you pointed out, when we switch to this topic, it's all about what you can buy now in today's prices. And look, I certainly think silver will outperform to the upside in the coming years. And part of that is that it is a smaller market, so it takes less dollars to actually move the silver price higher than it does to influence the gold market. And there's also a tangibility factor as well, Gord. So, if you've got $50,000 to invest in precious metals, that's only going to get you 1 kilo of gold, or barely 1 kilo of gold. It wouldn't even get you a kilo of gold in Australian dollar terms right now. Whereas it'd get you 65 kilos of silver or something like that right now. So people want to actually physically hold the asset. There's an attraction to silver. You can obviously also buy coins, which are easy to trade. So I think there's a lot of reasons to like silver from here. Obviously, it's been a bit painful for those that have been long over the last couple of years, but the future looks very good for silver in particular.
I think it's not getting the perception or the view that it should merit at these kind of prices. The old expression of gold is the currency of kings, silver is the currency of merchants, and debt is the merchant of slaves. And we have our share of debt, so I just leave it at that.
Absolutely, but again, I think it is. Whilst it's unfortunate that it's not getting the recognition that it has. It's probably understandable because especially if you think of the insto space, they've barely been interested in precious metals until now. For them, they have to go into the gold market. The silver market's just not really practical for them. So it's understandable why it doesn't get the sort of attention it probably deserves.
At some point it will. I need to switch gears again, and because I don't get a chance to really talk about Southeast Asia and Australia very often, and I'd love first of all your perspectives on what you think's going on generally economically, trade-wise in Southeast Asia from what you can see, and then second, more specifically, Australia. How's the Australian economy looking?
Yeah, look, if I talk briefly about Southeast Asia, I am an enormous sort of bull on the area over the next 10 to 15 years. I think we've got a couple of billion people, more than that, 3 billion people who are getting wealthier, who understand the value of working hard and saving and investing. There have obviously been misallocations of capital, on a grand scale, particularly in certain parts of China, and there will be some a price to pay for that. Broadly speaking, though, I'm bullish on the whole area, and it's one of the reasons why I feel very lucky to be in Australia, because we're obviously exposed to it. There are concerns, though. Obviously, there's been a huge pickup in fears around a sort of hard landing in China. It's interesting to see even in places like Singapore, property prices have come down quite a bit. And I know of a few sort of, I guess banks and Western financial institutions that are in place in Singapore that are, perhaps haven't been travelling as well as what they would have liked to have. If we bring it back to where Australia is, though, Gord, we face some pretty serious headwinds going, in the next few years. The worst of the fall in commodity prices is probably behind us, and that's hardly any great insight. Iron ore's crashed from $180. It's now closer to 50. It fell into the 30s at one point, I believe. So obviously, clearly, the worst of the crash is behind us. But we're going to be in a softer, real commodity environment. I'm talking about obviously industrial commodities and the like here for a few years. So the impact that'll have on corporate profits, on the budget for the Australian government will be felt for many years to come. But the two more relevant issues are firstly the actual investment in the mining sector, which reached 8% of GDP in Australia at one point. 8%, that's extraordinary. The long run average is closer to 2%. So there are tens of billions of dollars of capital investment sort of falling off. We call it the CapEx cliff down here. And we'll be feeling the pain of that for the next few years. The other thing, Gord, is that in the last couple of years, what's kept the Australian economy going is pretty much record home construction. The better part of a couple of 100,000 homes being built, homes and units being built in Australia. But even the Housing Industry Association here think that 2015 was probably the peak for home construction, and we're actually going to ease off. So in the next 3 years, we're going to have this mining capex cliff unwind. We've got a peak in home construction. We're also likely to have the closure of our car manufacturing industry as well. So those are major headwinds to growth here. And it also comes at a time where wages in Australia are now growing at less than the rate of inflation. And whilst we don't have a major sovereign debt issue here, what we do have is some of the largest or highest levels of private sector indebtedness in the world. So, General Joe Public in Australia, he has very little money in actual savings to spend. He or she's never been more indebted, and they're facing an uncertain employment outlook where their real wages are unlikely to keep pace with inflation. It's also worth pointing out that the vast majority of their financial assets are ring-fenced inside of superannuation, which they can't touch till they're 65. So you add all that up, we are going to face some pretty major challenges in the next few years. So whether or not Australia hits a formal recession to me is largely irrelevant. We will continue to see declines in real incomes, and we'll continue to see recession-like conditions, much lower interest rates from the RBA, at least 1.5%, if not lower, between now and probably the middle of next year. So all up, it makes for a difficult environment. Bringing that back to bullion, though, it reasserts the importance of owning gold, even for Australian investors, because the interest rates or the yields they're going to earn on cash are going to decline and fall below zero. They're practically at zero now anyway. And obviously with an economic slowdown, it's going to cause problems for our property market and also for our stock market, because our stock market, I think I discussed this last time I was on the show, but we have an almost unprecedented sector concentration. We have an almost unprecedented sector concentration within our stock market, where something like 45% of the ASX 200 is concentrated in financials, versus about 20% for the MSCI World as an average. So that's worked fantastically whilst we've been in this 25-year period with no recession, 25-year period of skyrocketing bank prices and housing prices and rising bank profitability. But that cycle is starting to change now. So for all of those reasons, we're going to have a tough few years. But, we're also the second largest gold producer in the world. We also do have the trade links with Asia. We also do have a well-developed sort of banking and wealth management system. So we have agriculture. So there's no reason to be, overly pessimistic here in Oz. It's just a case of being realistic about the challenge ahead.
Many of the observations in Australia are, I can name country after country in the developed world that have got exactly the same kinds of issues. Labor rates are not keeping up with inflation if you measure it properly. Their consumption is being pulled back, and we see world trade just absolutely plummeting in terms of U.S. dollars at frankly frightening a level of degradation. Last question, Jordan, for you. Do you see any positives on the horizon in terms of economic growth? Where is there an engine of economic growth? Are there any positive surprises that you think we could see in this year, 2016? We certainly have enough negatives that we can speculate on.
Look, Gordon, as I said, I think that the world's going to keep on turning, and even if we don't grow at any substantial rate, that doesn't also mean we're going to have an absolute collapse in GDP either. I mean, if you think back to when the global financial crisis hit, financial markets fell 50+%. GDP fell, but not by much. It was something like 2%, I think, global GDP fell. So, the value that we put on our output plummeted. The actual output only fell, by a smaller amount. I think we are going to see lower growth rates, if not sort of a global recession. So no, I don't think that there's any major green shoots on the horizon that are going to help the global economy grow in any meaningful way. China's slowing down. There's huge problems still in Brazil, Russia, you name it. And it was the BRICS that were the engines of global growth. And if you look in the developed world, Europe and Japan are still disasters, and even the US is slowing down. So no, I don't think we're going to see an uptick in global growth sort of anywhere on the immediate horizon. I also don't think it's any major reason to panic. It just comes down to, as an investor, making sure the portfolio is well constructed to protect yourself against the overvaluation in financial assets, and making sure you protect real wealth through this more challenging period.
The game of asset allocation has always been critical, but more so than ever. And looking at allocation that's maybe in areas that you haven't looked at as much before on the balancing, and that's is an individual decision, but I advise everybody to get a very skilled and professional financial manager to help them through this, who's doing a lot of independent reading on their behalf. We have to wrap, Jordan. How can our listeners find out more about ABC Bullion and the writing and the work that you personally put out?
Look, there's a few ways, Gordon. Obviously, the first place to find us is at our website, which is abcbullion.com.au. We're actually about hopefully a month away from doing a fairly major upgrade and adding some new products and services to that. ABC Bullion and myself are also both on Twitter. The ABC Bullion handle is just at ABC Bullion, and my Twitter handle is at Jordan Eliseo. All of the research that we publish is both contained on the website within our Investor Centre, and we generally put it on Twitter and on Facebook and LinkedIn, where we have pages as well. So we are pretty easy to find, very happy to talk to clients from all over the world. As I say, we have institutional and private clients that are located in every corner of the globe, and between ABC Bullion's trading services, our offices up in Hong Kong, and then our vault, which is located here in Sydney, we can provide solutions for investors that are interested in precious metals.
Thank you very much, Jordan, for your time. We at Financial Repression Authority really valued talking to all the gold experts all around the world at any given time, and silver, to really get a sense of the pulse of what's going on, and we really value your input at all times. We'll have you back again. Well, hopefully not as long as it's been since we last had you on, but we'll talk to you again later.
That sounds great, Gordon. Back anytime.
Talk to you. Bye-bye.
Take care.